We're seeing some small moves by investors at this hour as they weigh the risk of Iran possibly disrupting Middle East oil flows in response to those American strikes on its nuclear infrastructure over the weekend. Let's bring in Chip Rewey, who is a registered investment advisor based in New Jersey, to get some more perspective on the market's take on all of this. Thanks so much for being with us. What are you seeing in the markets this morning?
Well, good morning. I'm a little surprised by the muted reaction to the events of the weekend, but the market's been faced with a lot of uncertainty. And coming into the weekend, we were expecting the next 2 weeks to be highly uncertain. I mean, the decision on Iran, which we know now what it was going to be a 2-week decision. Tariffs will be decided by July 9th, as far as are we going to get extensions or deals, or the reciprocal tariffs go back on? And then we have Trump's bill, which he set a self-imposed deadline for July 4th. And, so there's a lot of uncertainty. And even Chair Powell said he's pausing to do anything to see what the uncertainty brings. And the market doesn't like uncertainty. That said, the S&P is up 2 for the year as of Friday. So the U.S. economy remains strong. I would think that over the next 2 weeks, we'll see some choppy moves in the market. And if you're a long-term active investor the way I am, you kind of like uncertainty, because that can give you the opportunity maybe to acquire some individual securities on that uncertainty.
Well, it's funny. I was going to ask you about that, because you could make the argument that some investors are constantly reminded that, the concept of buy the dip might be the way to go, unless a situation as big in magnitude as it can feel, unless that ultimately triggers some kind of fiscal or monetary response, or has some massive, implications for supply risk. And I guess we're trying to figure that out with oil. But, could you make the argument that we don't have to look any further than what happened with the Liberation Day worries back in April, and a market that came under pressure and then to a certain extent roared back?
Well, in retrospect, and in hindsight is always 2020, the Liberation Day tariffs were going to be unsustainable. I mean, levels of 50, 60% would be very damaging to the U.S. economy and the global economies. And maybe we'll settle in at 10, maybe a little above, maybe a little below, and who's to say? But the higher rates, even if something happens July 9th and they're put back on, I wouldn't expect to stay on for the long term. I don't think that's the desired end goal. But I think your point is exactly that. And if you have a long-term plan and a long-term view, you can use periods of weakness and volatility to take advantage of valuation opportunities. And I'm not so much saying buy the dip, because I'm not an ETF focused person. I don't buy the market. I buy individual securities. And I think there is opportunity, and I think there's growing differentiation in the market. I mean, for example, only 4 of the Mag 7 stocks are up this year, and 3 are down double digits, yet the S&P's up 2. And so you are seeing investors starting to differentiate. I mean, we don't have a massive tailwind of QE. We don't have a massive tailwind of big spending bills. We do have this uncertainty on a few items over the next 2 weeks, but the U.S. economy underlying remains healthy. And even Chair Powell and the committee said in their dot plots, and I know it's not a forecast, but they expect GDP to grow 1.4% this year. And with the S&P up 2, I mean, where would the S&P be without this uncertainty? Much higher, perhaps, and maybe. And I think that's why investors can look at rotating away from some of the larger stocks and maybe take some look at small mid-cap stocks. And one stat I'll throw out: if the investors in the S&P 500 in aggregate rotate 1% of their holdings in total into small caps, that's 19% of the Russell 2000 market cap. So the disparity in market cap and money flows can be substantial if the market gains certainty or gains confidence past this period of uncertainty.
And just for a little more context for our audience, Amazon, Apple, Alphabet, Tesla, these are examples of Mag 7 stocks that are actually down for the year so far. But I do want to leave people with a little bit more of an actionable idea. It sounds like you're looking for opportunity in small cap. What would be the kinds of investing areas then that you do like more specifically as someone who's looking for specific stocks?
Well, we've been recommending aerospace and defense stocks, both because the acceleration at Airbus and Boeing should provide a tailwind in earnings and revenues. And then, of course, military spending globally, even NATO stepping up. I think that's not so, we're onto a consensus view. So maybe there's still some opportunity. But where I'm looking now are regional banks in the US, because they still, in my view, are priced for a recession, priced for accelerating losses. And I think if you look at some of the regionals, under $10 billion market cap, you're seeing dividend yields 4 or 5%. Remember CECL, the regulation change post the financial crisis, means you have to fully account for any expected losses. So the loss reserves look pretty full. They have large capital buffers, maybe 3 times what they had before the financial crisis. GDP remains healthy, and we're seeing some easing regulation. Remember, in May, the OCC re-eased some merger rules. So I think that group works from both a safety and potentially an offense point of view, where you can get some yields that are over the 10-year Treasury in the right stocks with some capital appreciation opportunities.